Assalamualaikum. Good morning, everyone. Thank you for joining today's meeting. Okay, for today, the purpose of this meeting is to review and analyze the financial statement of Pensonic and provide the recommendation on whether the company's shares are worthy of investment. Then each of us has been assigned different aspect of the financial analysis, right? So shall we start with the financial statement review?
I'll start with the balance sheet. Pensonic current assets stand at 162.25 million, while its current liabilities are at 110.37 million, giving us a current ratio of 1.47. This indicates that Pensonic has a healthy level of asset to cover its short-term liabilities.
Looking at the income statement, Pensonic has reported a gross profit of 51.73 million on sales of 273.20 million, resulting in a gross profit margin of 18.94%. However, their net profit margin is quite low at 1.46%, which suggests potential issues in managing operational costs.
For the cash flow statement, I noticed that while Pensonic is generating a positive cash flow, their cash flow in investment of financing activities is fluctuating and is decreasing. So this could be due to their ongoing investment in technology and also market expansion.
For the current ratio, as mentioned, is 1.47, which is generally healthy. However, the asset test ratio is 0.75, indicating limited available cash to cover immediate debts. This suggests that the company might face liquidity issue it doesn't manage inventory more effectively.
For efficiency, the inventory turnover ratio is 2.51 times, meaning that Pensonic is selling their inventory quickly. However, for their account receivable turnover is 88 days, which means they collect their payments from customer and suppliers quite longer.
For the Pensonic debt ratio is 49.38%, showing it's not overly leveraged, but the time interest earned is 159, which is risky because it just cover interest obligation. This indicates that the company needs to provide its earnings or refinance its debt to lower interest expenses.
From a profitability standpoint, while the gross profit margin is decent, the net profit margin and return on equity are low at 1.46% and 2.88% respectively. Additionally, the return on assets is only 1.25%, indicating that the company is not using its assets effectively to generate profits. This suggests that despite good sales, Pensonic is struggling to convert its assets into significant profits. So we need to improve our cost management and explore new markets to enhance profitability.
Thank you all for your analysis. It's clear that Pensonic has strength in inventory management and maintaining on current ratio. However, the low net profit margin, return on equity, and return on asset are concerning. So I think we should discuss how to address these weaknesses.
One area we could focusing on reducing operational costs and negotiating better terms with suppliers. Additionally, we need to streamline our receivables process to improve cash flow.
From a marketing perspective, we should focus on high margin products and expand our market reach, especially in the Southeast Asian region, where there is potential for growth.
I agree with Ms. Rezana. Moreover, we could explore refinancing options to lower our interest expenses, which will improve our time interest and ratio and overall profitability.
Okay, based on the analysis presented, I recommend that we should proceed with caution regarding investing in Pensonic shares. While the company has potential, it needs to address its profitability, leverage ratio, and particularly its return on asset to be a safer investment. Any objection or additional suggestion? Before we wrap up, does anyone have any question or require further clarification?
I have a question. What specific steps can we take to improve the net profit margin and ROA in a very short term?
Thank you for the question, Anis. I will answer for that. To solve it in the short term, we could immediately start by cutting down unnecessary operational costs and negotiating contract with suppliers to reduce expenses so that we can gain back our net profit margin. Additionally, better asset utilization could improve return on asset.
Yeah, I have a question. How can we leverage our current market positions to boost profitability and improve ROA?
Well, to answer that, we should focus on launching marketing campaigns that highlight our high margin products and explore new markets with less competition. Also, we need to assess underutilized assets and consider selling or repurposing them to improve return on assets.
I have a question. Given the low TIE ratio, how should we prioritize debt repayment versus investing in growth opportunities?
Thank you, Fatini. For prioritizing debt repayment, we should carefully balancing our approach. While it's important to reduce debt to improve our time interest and ratio, we should not neglect our growth opportunities. We could prioritize paying off high interest debt first and then reinvest in areas where they can promise higher returns and ensuring that both goals are met efficiently.
Thank you everyone. This was a productive session. Let's summarize our key takeaway. First, we need to enhance profitability by managing costs better. Second, improve cash flow. And last, explore refinancing options. We will reconvene maybe next month to evaluate our progress. Okay, thanks again for your contribution.